Hello and welcome to the Equifax Consumer Insights webinar for 2025 Quarter 3. I'm your host for this webinar, Carrie Chong, Head of Insights for Equifax. Thanks for joining, especially for those who have logged in a little bit earlier. We've got a big audience coming through today, so we might give people a minute or two just to join. It is sort of lunchtime, so I assume people have either had lunch or eating lunch at their desk and watching this webinar. So we'll give it a couple of minutes. Really appreciate those who have already joined us. I know that quite a few of you have already joined us before, so really looking forward to share the Q3 results with you. Well, Q2 results, but we're in Q3 right now. Yeah, really looking forward to share that with you shortly. The number of participants is rising, which is great to see. For those in Sydney, I hope you're staying dry as well. During this time, I might just walk you through the platform. Look, if you've been here before, especially, it shouldn't be foreign. The Zoom platform is well known. Feel free to put in questions throughout the webinar for our speakers. They will be addressed towards the end of the session. Just a reminder, if we don't go through all the questions, we'll definitely get back to you on the questions that you've posted. But for those who've selected the anonymous sort of question submission, it'll be hard for us to return back the answers to you. So if you'd like us to reach out and make sure that you don't do the anonymous submission, and then we'll get back to you with your questions if we don't get through them on time. To begin, I would like to acknowledge that I'm hosting this webinar from the lands of the Garamako people. I also acknowledge the traditional custodians of the various lands on which we all work today, and the Aboriginal Torres Strait Islander people participating in this webinar. I pay my respects to elders, past, present, and emerging, and celebrate the diversity of Aboriginal peoples and their ongoing cultures and connections to the lands and waters of New South Wales. So let me quickly introduce myself. I'm Carrie, Head of Insights. My team of analysts monitor consumers and commercial market trends across the region. We focus on providing actionable insights to help clients and consumers understand the latest trends. Also here joining us today, we've got Stuart. Those of you who've worked with Equifax would probably know Stuart, Head of Advisory who has been with Equifax for close to 20 years. Stuart leads a team who consult to a broad range of lenders on good practice in credit risk management and effective use of risk analytics. Stuart is an industry expert in consumer credit risk management, credit risk analytics, risk management reporting, and the introduction of comprehensive reporting to the Australian marketplace. Also joining us here today, we've got Ankit Arora. Ankit is our Senior Product Manager in the consumer risk space at Equifax and has over a decade of experience in the finance field. Welcome to both of you here today. Thank you for joining us. Just for those who have just joined, you have joined our consumer webinar where we'll focus on the how credit risk market is tracking over the last quarter. Now, without further ado, I am going to pass it on to Stuart to take you through the latest trends. Stuart, over to you.
Thanks, Carrie, and thanks to everybody for joining us. Hopefully you'll get some interesting information out of our webinar today. We do have some of our metrics that are starting to move a little bit, so that's always creates an interesting inflection point in the market. So as I said, we've started to see some ongoing growth in both unsecured and secured products, but particularly in the unsecured space. Particularly like buy now, pay later, and I'll come into some of the reasons for that going forward. Delinquency, we're seeing some muted trends starting to emerge there. Some of that seasonal, some of it more of an ongoing trend. And however, not a lot of movement in hardship, if anything, moving backwards a little bit in terms of hardship. So that's good to see. Overlaying all that, of course, is the economic environment, and everyone, I'm sure, has been watching the RBA results and how that's going to play out, both currently in terms of interest rates and going forward. So as I said, we are starting to see some sustained movement in credit demand, both in secured and unsecured products. So on the secured side, we're seeing a sustained uptick in particularly mortgage portfolios, not so much in auto. And some of that could be potentially attributed to the movements in the benchmark interest rate. On the unsecured side is where we're seeing some bigger movements. So we've seen an increase in credit card demand, and underlying that, there is a number of different lenders that in different sectors of the market that credit card demand is emanating from. So it's not just a single marketing campaign that anyone's run. It is across a number of different lenders. Buy now, pay later, we certainly expected to see some movement in the buy now, pay later space, particularly with the change in regulation happening on the 11th of June. So for buy now, pay later providers came into the National Credit Act on the 11th of June, bringing with it the responsible lending obligations. And we expected to see that would drive some movements in credit demand, and it certainly has. We've seen a significant bump, 30% increase year on year in the second quarter related to buy now, pay later. So there are obligations for using credit inquiries as part of that regulatory change. And so we did see a couple of changes there. But there was also some changes in products, new product launches, and other changes that saw an increase in the credit demand coming through. Personal loans too, we've also seen and some sustained increases, so up to 8.5% for quarter on quarter. But we have in previous quarters we've made mention that we have seen that coming through, and you can see that from these trend graphs that we in the post-COVID period. We had some initial surges in credit demand that then died off and actually went negative for about a year there in 2023. But coming through the back end of last year and into this year, we're seeing some sustained increases across those portfolios. So looking now into some of those in more detail. So the overall economic environment that we're playing into hasn't really moved that much, but we have seen some trends there as well. So well publicised, the headline inflation rate coming down to the bottom end of the RBA's 2.3% to 3% band. There was a lot of expectation that would result in interest rate decreases during July. That didn't happen, but with that index moving further lower, the probability of that coming through during August is certainly very high. Unemployment ticked up, I think, 0.1% since the last time we looked at it, so remaining very low, and that's certainly underpinning some of the delinquency trends that we're seeing in market. Official cash rate hasn't moved, as I said, from the RBA, and household savings is also sitting at very low levels. So a lot of households have reduced those buffers over the last couple of years that had built up during COVID, and now don't have a lot left in the tank to be able to absorb significant variations in cost of living. So now looking into some of the portfolios in a little bit more detail, starting with mortgages. And mortgage growth in terms of the number of accounts has remained relatively muted So, year on year, a decrease of 1%, so close to line ball. But we are still seeing an increase in the average limits coming through. So still some growth in that portfolio, both in new accounts and the overall portfolio. In terms of arrears, 90-day is pretty much on par to where it was last year in terms of the number of accounts. However, the limits have gone up a little bit in that space. We have done some analysis in more recent times, looking at the where that and what type of mortgages that are showing more arrears. And some of our latest conclusions have been some of that is actually coming through in the greater than $2 million share of the portfolio, so mortgages over $2 million. So we're doing some further work to delve into that, where we are seeing those significant increases in mortgage arrears coming through in that cohort. Credit cards is another one where we're seeing a bit of movement. Slight decrease in the total number of accounts and amortized limits. So we still haven't seen that credit demand that I talked about growing on one of my previous slides, translating through to accounts being opened as yet. And there has actually been a slight decrease in the average limit per account. So it'll be interesting to see as that increase in credit demand continues to play out, how much impact that has to portfolios and accounts that are actually opened. Delinquency rate on cards is pretty much, again, line ball, and a similar trend to mortgages, pretty similar in terms of the number of accounts, but we have seen a step up in the total limits, particularly at that 90-day level. A bit of increase, as you can see, in the top black line coming through at 30 days as well. So we'll certainly watch as to see does that contribute to a higher 90-day rate in the coming months. Personal loans. So looking at the portfolio here, so that demand that we've seen for personal loans coming through over the last few quarters is certainly translating into growth in new accounts, both in the number of accounts and the amortized limit. So not only more accounts, but with higher limits that are being opened for those accounts as well. So some quite strong and sustainable growth occurring in the personal loan portfolio. Personal loan arrears, we do see a bit of a seasonal trend in personal loans, and we are in Q2 is pretty much the peak of what we see in personal loan arrears. So, but we have actually seen a slight decrease in the number of accounts in arrears, but again, an increase in the limits that are in arrears, particularly at that 90-day level. So again, those that are going into arrears are for higher amounts than what we've seen in the past. Now, we will expect to see that absolute number come back down in quarter 3 and quarter 4 is what usually transpires in that seasonal trend. Buy now, pay later. We again have seen an increase in the number of accounts and amortized limits coming into buy now, pay later. Now, underlying this data, there is one additional provider that joined during the period. So that probably explains the majority of the increase in the number of accounts being reported to us, but also on the right-hand side, that decrease in the average limit is also due to that new provider. Wasn't one of the biggest providers in market, but a medium-sized provider that does have a significant number of accounts, certainly enough to move the dial a little bit on these metrics. Delinquency rates have kicked up again as a result of that additional provider coming in with a slightly higher risk portfolio than others that we have reported in the past. Underlying trend, though, is pretty much in line with what we've seen in the past if you exclude that additional provider. Auto loans, so we have seen an ongoing and sustained increase in auto loan arrears over the last couple of years. We have seen that come down a little bit in Q2, which is good to see. Again, some of that seasonal trend perhaps starting to play out there. And so one that we'll keep to see if that is actually translating into a change in the longer term trend, or whether it's more of a one-off. Financial hardship, as I said on one of my earlier slides, has come down a touch. Now, given that mortgages make up around 55% of the hardships that we have listed, they do move the dial, and so we've seen the mortgage hardships again come down slightly, whereas the likes of auto is continuing to increase. Personal loans and cards are pretty much line ball, and not a huge variation between states in terms of the mortgage hardship numbers. So at this point, I'll hand over to Ankit for our consumer spotlight session. Ankit.
Thanks, Stuart. Okay. So today what we want to do is we want to explore the benefits of our Access Seeker products earlier into the application process and how this can positively impact consumers, brokers, and the lenders. At Equifax, our core mission is to empower customers with comprehensive products, services, and insight. And these offerings cover every phase of the consumer lending across both digital and indirect channels. For our lender partners, today you leverage our Equifax Apply credit report to conduct the robust credit assessment and make well-informed lending decisions. For a valued broker community, our Access Seeker reports are an essential tool for determining which lenders are probably the best fit for a consumer-specific need and helping to streamline the application process. So let's look at what is an Access Seeker report. So if we move on to the next slide. Thank you. An Access Seeker report is designed to assist individuals who are working with an agent, typically a broker, to interact with a credit reporting body such as Equifax or credit provider. Now, this report offers broker a crucial access to the individual's consumer credit report and the score. It also includes detailed information such as their credit liabilities, limits, repayment history, and any hardship information. A critical advantage of running an Access Seeker report is that it does not impact the consumer's credit score. While it leaves a file access record, which is only visible to an individual if they check their own credit file. And this is not also visible to a lender as well. So the vital distinction enables the proactive and informed decision-making without negatively penalizing the consumer. So now, this brings us to our first question for today. Over to you, Kari.
Yes, so I would like to get a bit of opinion going and see what's your view on, so brokers, you're currently want to get a view from the audience here today. If you're currently utilizing the credit reports Access Seeker service, and what's your engagement, whether you've heard of it, if it's something that you advocate for. So what's your view on Access Seeker report? So vote away. I love watching these numbers go. So it's getting a lot of sort of two ends, either those that are always using it, those that are not applicable, and those somewhere in between. A bit of a couple of minutes, a bit halfway done. Okay, I think we're getting a good indication. Looks like There's probably, it's like a tie. There's those that are very strong at always. We've got about 40% of always, and we've got 40% of non-applicable, but we do have about 17% of those that are sometimes using it. So that's a good indication. So there's a lot of awareness of what it is already, Ankit. I'll just stop that now and share the results here. Thank you, Ankit. So yeah.
Thank you. Thank you. I think it appears that many of you are utilizing or have integrated access seeker reports, and obviously there are some that haven't utilized it. So what I want to do is I want to delve into why running an access seeker report is beneficial for both for brokers as well as for lenders. Now, this report offers additional insights that are truly transformative. For a broker, it helps with ID verification, confirming the applicant's identity, assessing the consumer's true capacity to afford the loan, and also verifying the credit commitments and revealing any undisclosed liabilities, and also gaining a comprehensive understanding of their credit score and the credit history. Now, if we move on to the next slide, I want to talk about some tangible benefits that Access Seeker Report brings to both brokers and lenders. And by leveraging these reports earlier in the credit application process, we can unlock multitude of advantages. Now, the first one is, I would say, it helps in the improving your conversion rates. So you're submitting a complete and accurate application from the outset, which directly translate into a higher likelihood of the approval. And the other important one is the reduced application rework. No back and forth for missing information. You can confidently prepare the application, saving the valuable time and effort for everyone involved. And also the critical one is helping you with the responsible lending obligation, because it allows you to identify and validation of their credit commitments, ensuring the responsible lending practices are there. And what are the benefits for the lenders as well? The lenders are able to make faster and more confident decision knowing the appropriate checks have been performed, and obviously it is accelerating the time to yes. And as many of you may be aware of it, this is why many lenders have enabled our Access Seeker reports for brokers into a next-gen or an apply online workflow, application workflow. And one of the other advantages for you as a broker that you can deliver more value to your customers. You can educate your customers on what is the importance of their credit report and work with them to improve their serviceability. For instance, a closing an unused facility. Obviously, this fosters trust and better financial health for the consumers. Now, I think in the essence, by integrating the Access Seeker report into your application workflow, we create a more efficient, transparent, and a successful lending ecosystem for everyone's involved. Now, if you move on to the next slide, now this slide basically demonstrates the effectiveness of Equifax data. By utilizing the Equifax Access Seeker report, brokers can guide consumer toward a more informed lender selection. And this significantly increases the chances of their approval on their initial application. Conversely, a lack of this comprehensive information can result brokers submitting an application with a high probability of rejection, leading to unnecessary rework and an unhappy consumer on the other end. That's all for me. Now I'll hand over to Kari.
Thank you. So I'll bring Stuart back in. So now that Ankit's give you a good understanding of what Access Seeker is, the team's been looking at, hey, there's a lot of information here around Access Seeker. So we've looked into how to use Access Seeker information to give the audience here a view of what's the intention, given that the interest rate changes lately, there's been a lot of mortgage demand. Can we look into the intention to buy? Can Access Seeker be used in a slightly different way to give us a view into that? So Stuart, I'll let you take the audience through what the team has found.
Thanks, Carrie. And as Carrie said, Access Seeker shows us pre-application demand, so allows customers to shop around for credit, and so we get an earlier indication. So one thing that we've wanted to have a look at is first-time buyer demand. And we're starting to see with and probably correlated with some of the rate cuts coming through from the RBA, some increases in the proportion of first home buyer demand coming through the access seeker channel. So first home buyers do seem to be looking for more mortgage information about mortgages and what they may be eligible for in preparation for an application. Overall, we're seeing some growth across a number of states, but particularly some of the potentially more affordable states like South Australia and Queensland, more so than some of the larger states such as Victoria and New South Wales. Looking in a little bit more detail into the trend on those states, and again, you can see that increasing trend from those more affordable states coming through in the access seeker demand. So certainly, seems to be some activity building in the first home buyer space. Breaking that down in a little bit more detail, so looking at the age cohorts of first home buyer demand through access seeker, and we can see a lot of that growth is starting to come from the lowest age group, 18 to 25s. So a little surprising there. We generally, with the price of houses these days, we do see that first home buyer demand is building into older age brackets, but yeah, it certainly is starting to come through from that 18 to 25 age group. In terms of the proportion of total intention to buy, you can see that yellow bar at the top has been growing in that 18 to 25 age group, but also seeing quite a bit of strong demand continuing from the 26 to 35s and older age brackets. So yeah, certainly growing in those younger groups. That's also just starting to translate into to loan applications. So a bit more of a time delay in mortgage interest in access seeker translating through to credit demand. But just in the month of June, we have seen an uptick compared to the same month last year in the applications coming through from first home buyers in particular. Looking at a bit more of a regional basis, so looking at that first home buyer demand in capital cities and regional areas. So again, the likes of Hobart and regional centres starting to show greater levels of first home buyer demand than some of the other major centres. And across regional areas, we have seen some of those areas closer to capital cities, such as Central Coast and Toowoomba, have been showing some much stronger first home buyer demand starting to come through in those regional areas. So again, that trend to the more affordable areas, either in more affordable states or locations adjacent to the capital cities, are seeing a bit stronger demand coming through from first home buyers. Okay, that's the end of my slides. Carrie, back to you.
Thank you, Stuart. As always, it's always good to see a flood of questions coming through. So keep them coming and we'll take them one by one. Like I said before, if we don't have enough time to get through them, we'll get the answers back to you after the session. So first question, Ankit, if I can invite you to answer this one. Obviously coming from someone who has some knowledge of the Access Seeker report, can you explain why the credit reports contain 3 different scores?
Yeah, definitely. So obviously, as you probably are aware, Equifax maintain several different credit scores in the market, and it is crucial for brokers to understand which score a particular lender is using. And in a credit report, you can see up to 3 credit scores. The first one is Equifax One Score. The One Score is a comprehensive and a highly predictive credit score that is leveraging the actual CCR data, geodem attributes, and a patented decisioning technology and the explainable AI. Now, the other benefit of One Score is it provides a consistent score across the entire credit lifecycle, from inquiries to originations to account management. The other score that gets returned in the credit report is Equifax Apply Comprehensive Score. It's an older generation comprehensive score that was built in 2014 based on a very limited sample CCR data that we had on the bureau. And the last one is Vita Score 1.1. Now, this is a legacy score used by lenders who do not participate in comprehensive credit reporting, and it's a negative score, meaning it's built only on the negative data from the credit file. So that's the reason, because we have got lenders participating at the different participation levels. Some are negative only, and some are comprehensive, and some have transitioned and adopted One Score. Hence why we arm the broker with all the 3 scores so they can make an informed decision.
Yeah, and we do a bit of education work in this space to educate brokers on how to interpret and understand this as well, right?
That's correct.
So in regards to that, there's another question on how is there a way, or how do lenders ensure that brokers are using the report, reviewing the report, and acting on it? Is it true that some of the brokers can order the report, but either they don't know what to do with it or not sure how to use it? What's your view on that?
Yeah, definitely. I think as what we have seen is lenders are increasingly finding where brokers are running an access seeker report, they are providing accurate application information, which definitely translates to a faster time to yes. Now, hence why many lenders, as you probably are aware, have implemented access seeker report in application workflow through NextGen. So where brokers have done a report, and obviously a lender gets an indication that broker has reviewed the access seeker report and all the liabilities have been confirmed. Also, not only this, what lenders are monitoring it is the application that they're getting from broker, how successful are they in turning into an actual application, an open account, and the approval, right? So I think that gives confidence to lenders more and more, because at the end of the day, lenders are exactly seeing the same information when they do their hard check or pull the report for that individual. So I think they get a sense of a trust, and that's why they have enabled it for brokers and more brokers to use it.
Right, thank you. So you may have already answered this question. Do you have any data on lenders that use the access seeker and their MIR rate? Sorry, it's terminology I'm not too familiar with. MIR rate versus those who don't. Is that the conversion rate? Do you know, Ankit?
I believe it could be the conversion rate, but I think what we have seen is don't have any specific data as yet, but many lenders, including Big Four and some of the international lenders, they have said where brokers are using the access seeker report, their time to yes has been significantly improved, and it's been improving over the years compared to the brokers that are not using it.
That's great. So in the first few slides of the access seeker report, it says that it is only assisting the individuals to deal with the CRB or credit lender. How do access seeker be useful for credit lender when the regulation does not allow credit lender to access this?
Yeah, definitely. Obviously, yes, the credit reports, the access seeker reports are for brokers, and how this would useful for credit lenders, obviously, when the regulation doesn't allow. Obviously, what it gives is it gives a lender surety that broker has done all the due diligence in terms of the credit liabilities, and they're probably going to see the same information when they're going to pull a hard inquiry or a credit report when they're going to make a decision. So all it is doing is helping lenders to make sure all the checks have been done, and most likely the liabilities are likely going to be matched at what's been disclosed versus what they're actually seeing on the credit application, and that ultimately leads to a faster decision timing for our lenders.
Thank you. And another one, how can we explain to the customer the difference of an access seeker from what they are seeing on the paid subscription? Is that something that we can? This sounds like a broker or someone who uses access seeker, right? So how do we explain to the customer the difference of access seeker from what they see on the paid subscription? Have you come across anything like that, Ankit?
Yeah, definitely. I think what they mean is, obviously when brokers are reviewing a credit report, they are seeing that information, and obviously when a consumer gets their own credit report through Equifax directly or through other channels, they see the information. The information should be 100% identical. That's why the individual get to see the same one score. That's what we are returning to the broker. So it should be identical. There shouldn't be any discrepancies as such.
So how long does it take for someone to improve the comprehensive score if someone has a low score now, financial conditions improved and pay the bill and repayments on time? That's like a fairly generic sort of score question. Ankit, would you like to share your thoughts on that?
Yeah, definitely. I think one of the critical factors is once they have an open account, and if they are paying that account on time, there are no late payments, obviously that will gradually improve the score. Things like if you're having a liability that are no longer used, you should obviously close them, and that counts towards your credit limits. The other thing is, obviously, you need to make sure that you're not shopping around for credit too much. Obviously, you should only apply when you need it, and having less inquiries can improve your credit score. So these are some of the factors, and it will gradually jump over time.
That's right. So, sorry, there's a lot of questions for Ankit. That's great. Can you confirm, wait, sorry, 1 second. Can you confirm that the report obtained by an access seeker is not visible to the lender? That's something that we're very conscious of, right?
Yeah, that's correct. The report, when an access seeker does a report, it leaves a soft touch on the bureau, which we call it under file access, and that is only visible to a consumer. So it's not visible to lender.
Okay. I might give Ankit a little break and go to Stuart for a little bit. Is the increase in buy now, pay later, so jumping back to the overall analysis, is the increase in buy now, pay later demand actual consumer demand, or is it that buy now, pay later have to undertake credit inquiries because of the legislation changes? Stuart, what's your view on that?
So in Q2, it's probably a little bit hard to differentiate all of those factors because there has been quite a lot of change in market. So some of the buy now, pay later providers have launched different products. Others were not previously doing credit inquiries and have started doing credit inquiries. And some have been changing the nature of the credit inquiries that they're doing. So there has been quite a bit of activity occurring around that regulatory deadline. The other thing is that there may have been some that were getting some of that work done prior to or changing some of their customer relationships prior to the change coming in on the 11th of June. I think we'll get a better reading of where the underlying trend is going to play out as we move into Q3 and Q4. But certainly buy now, pay later does remain a very popular credit product in the Australian marketplace.
For sure. So over to arrears and hardship a little bit. So have you ever done any analysis on arrears plus hardship? How does this compare to previous statistics where hardship wasn't reported? So on that question, I was thinking through it myself whilst I was looking it through, and we certainly can. I don't have the numbers right now, but it's something that we can probably look into and report back into this session. But we do.
Yeah, I can just add to that, Carrie.
Yes,
again, it's not something that I've specifically looked at. However, I have been looking at the proportion of accounts that we have on the Bureau with repayment history that weren't reported prior to the introduction of financial hardship information and moving forward, to see how much of that was due to errors or other issues and how much of it was related to hardship. And yeah, it has moved the dial a little bit. We do see a lower proportion of accounts not reported these days. The other thing that I have been doing, which has been quite interesting, is looking at, for accounts that did go into hardship, what has been the subsequent outcome. So were those accounts up to date when they first declared hardship, or were they already in arrears? And then what happened subsequent to that hardship period? Was the account closed? Did they recover and get back to an up-to-date scenario, or did they go back into arrears? And that's certainly been some interesting analysis to see how that's playing out. I guess the general conclusion has been that on the whole, the hardship treatments being applied by lenders do seem to be quite effective in engineering better outcomes for the individual subsequent to that hardship period. But that hardship outcome analysis could potentially become part of something that we could bring to a future spotlight in these sessions.
Definitely, we'll look into that. So Ankit, now that you've had a break, let you breathe a little bit, there's another question for you. Yeah. How do brokers get set up with Equifax to pull the Access Seeker credit report? Can you take us through that?
Yeah, definitely. So I guess broker has got several different options to set up for the Equifax credit reports. I think the first one is through an aggregator. So obviously Equifax has integrated its Access Seeker service with majority of the industry aggregators, and brokers can typically subscribe to that service through them. And this is the most common and the streamlined method. At the same time, Equifax do have special arrangements with the leading industry bodies such as MFAA and FBAA, and members of these associations are eligible for a special pricing and a dedicated access to the credit reports. Or the third option is, if the broker does not work with an aggregator or prefer to subscribe directly because of their scale, they can definitely contact Equifax to get their direct account set up with Equifax, and they can conveniently access the credit reports through a manual channel or through an API as well.
Thank you. And so to follow on from that question, there's another one that's asking, is there a difference in the Access Seeker report versus the usual Equifax report? Like, are there any information that's not included in the Access Seeker report? Can you take us through some of those?
Yeah, definitely. The information should be identical. The only difference that you would see is in the Access Seeker report, typically we include up to 3 scores so that the broker can make an informed decision depending upon the lender they are working and where that lender is in the journey, whether they are on a negative reporting and a comprehensive reporting. So that's just from the score perspective. But apart from that, information on the Access Seeker credit report or a consumer getting information directly from Equifax, this should be identical because they get to see all the comprehensive credit reporting information.
Thank you, Ankit. Just looking at the time now, there are a lot of questions that we didn't manage to get through. And like I said before, we'll come back to those who've submitted questions after the webinar. So thank you so much, Stuart and Ankit, for taking the audience through the latest trends in consumer market and the Access Seeker report and how it's used. Just a quick reminder for the audience that there will be a short survey at the end of this webinar. We would really appreciate any feedback, and a recording of the presentation will be made also available for our audience here today. So thank you very much for your time, and I look forward to seeing you in the next webinar. Thank you.